Which is better, chasing the next big tech company or hunting for hidden bargains in the stock market? Growth stocks and value stocks represent two of the most fundamental investment philosophies in the world, and billions of dollars are bet on each side every single day. Here's the thing. Most everyday investors don't fully understand the difference, and that gap in knowledge can cost you big over time. Today we're going to break it all down. What each style means, how they've historically performed, and how you can use both to build real, lasting wealth. Let's get into it. Let's start with growth stocks. A growth stock is a share in a company that investors expect to grow significantly faster than the overall market. Think of companies like Amazon in the early 2000s or Tesla a decade ago. These companies are often in hot sectors: technology, biotech, clean energy. And they tend to reinvest every dollar they earn back into the business rather than paying you dividends. Because investors are paying for future potential, not current earnings, growth stocks often trade at high price-to-earnings ratios. That's a valuation metric comparing stock price to profits. You're essentially betting that the company's future is going to be even bigger than its present. Now let's talk about value stocks. Value investing is the philosophy made famous by Benjamin Graham and later Warren Buffett. The idea that Mr. Market sometimes misprices companies, and a patient investor can buy a great business at a discount. Value stocks are shares that appear to be trading below what they're actually worth based on fundamentals like earnings, assets, and cash flow. They tend to be in more established, slower-growing industries. Think big banks, utilities, or manufacturing companies. They often pay regular dividends, which means you're getting paid to wait while the market catches up to the true value. It's a slower, steadier approach. But historically, it's produced powerful results. Let's look at the numbers because this is where it gets really interesting. This chart compares the annualized returns of a growth-focused index, represented here by the Russell 1000 Growth Index, against a value-focused index, the Russell 1000 Value Index, over roughly the past 2 decades. What you'll notice is that growth dramatically outperformed value during the 2010s, largely driven by the massive rise of tech companies like Apple, Microsoft, and Google. But value had its own dominant era in the 2000s. The data tells us that neither style wins all the time. They tend to run in cycles, which has major implications for how you build your portfolio. We'll get to that in a moment. Here's a number that really puts things in perspective. A hypothetical $10,000 invested in an S&P 500 Growth Index fund back in 2004 would have grown to roughly $117,000 by 2024. That's based on approximate historical index performance. Now, a similar $10,000 in a value index? Still impressive. Around $63,000 over the same period. Both are life-changing compared to leaving money in a savings account. The point here isn't that growth always wins. It's that long-term investing in either style, done consistently and patiently, builds real wealth. This is for educational purposes only, and past performance doesn't guarantee future results. So how do you actually identify whether a stock is a growth stock or a value stock? It comes down to a few key financial metrics. First, the price-to-earnings ratio, or PE ratio. Growth stocks often have PE ratios of 30, 50, even 100 plus because investors are paying for future earnings. Value stocks typically have PE ratios below the market average. Second, the price-to-book ratio compares the stock price to the company's actual assets. Then there's revenue growth rate. Growth companies show explosive top-line expansion, while value companies are more steady state. And finally, dividend yield. Value stocks often pay dividends, growth stocks usually don't. Understanding these metrics gives you a real analytical edge. Here's a visual that really drives home the valuation difference between growth and value stocks. This chart shows the historical average price-to-earnings ratios for the Russell 1000 growth versus value indexes. Notice how growth stocks consistently command a premium valuation. Investors are willing to pay much more per dollar of earnings because they're betting on faster future growth. Value stocks, by contrast, trade at a discount to the broader market. When that premium gets extremely wide, like it did in 2020 and 2021, it can signal that growth is overheated and a rotation back to value may be coming. Understanding these cycles helps you invest with context, not just emotion. Growth stocks don't perform equally well in all environments, and this is critical knowledge that many beginner investors learn the hard way. Growth stocks tend to thrive when interest rates are low. Here's why. When rates are low, investors are more willing to pay a premium today for earnings that won't arrive until years from now. It's like low mortgage rates making expensive homes more affordable. But when the Federal Reserve raises interest rates, like the aggressive hikes we saw in 2022, growth stocks get hammered. Those future earnings suddenly look less valuable in today's dollars. In 2022 alone, the Nasdaq, which is heavy on growth stocks, fell roughly 33%. Understanding the rate environment is essential when holding growth stocks. Value stocks play by different rules. They tend to do well when interest rates are rising, because many value companies are in sectors like banking and financials, which actually benefit from higher rates. They also tend to outperform during economic recoveries, when the market starts to recognize that beaten-down companies are actually undervalued. In 2022, while growth stocks crashed, value stocks significantly outperformed. The Russell 1000 Value Index fell only about 8% compared to a 29% drop for the growth index. And here's a bonus. Value stocks often pay dividends, which means you're collecting income even when prices are flat. In uncertain markets, that cash flow can be a real psychological and financial anchor. This chart makes the 2022 divergence crystal clear. When the Federal Reserve began its most aggressive rate hiking campaign in 4 decades, pushing the Fed funds rate from near 0 to over 5%, growth stocks cratered while value held up far better. The growth index dropped nearly 29%, while value declined only about 8%. This wasn't a coincidence. It was the market repricing future earnings at a higher discount rate. For investors who were 100% in growth going into 2022, the pain was real. This is exactly why diversification across both styles and understanding the macro environment can help protect your portfolio when conditions shift. Here's something that might surprise you. Over the very long run, we're talking nearly a century of data from the landmark Fama French research, value stocks have historically outperformed growth stocks by approximately 3.5 percentage points per year on average. That research, published by Nobel Prize-winning economist Eugene Fama and Kenneth French, analyzed U.S. stock returns going back to 1926. Now that long-run advantage has been challenged in recent decades, particularly the 2010s growth boom. But the historical data is a powerful reminder that value investing isn't just an old-fashioned idea. It has deep academic roots and a long track record. Context matters when interpreting any single decade of returns. So, which should you own, growth or value? Here's what many financial experts suggest. You don't have to choose. In fact, a total stock market index fund, like those tracking the Wilshire 5000 or the Russell 3000, automatically holds both growth and value companies in proportion to their market size. That means you're capturing the upside of both styles without needing to predict which will win next. If you have a longer time horizon, say 20 or 30 years, you might consider a slight tilt toward growth. If you're closer to retirement and want more stability and income, a value tilt may make sense. Many target date retirement funds already do this blending automatically. Consider speaking with a financial advisor to find the right mix for your situation. Here's one way to think about blending growth and value in a long-term portfolio. This pie chart shows a sample allocation model that incorporates both styles alongside bonds for stability. This is a hypothetical example, not a recommendation for any specific individual. But it illustrates the concept of building a diversified portfolio that can perform across different market environments. The U.S. large cap blend in the middle covers both growth and value. The dedicated growth and value allocations let you tilt in either direction. Bonds and international holdings round out the diversification. Again, your ideal allocation depends on your age, risk tolerance, and goals. Always consider consulting a financial professional. Let's bring it all together. Growth stocks offer exciting upside potential, but come with higher risk and sensitivity to interest rates. Value stocks offer stability, dividend income, and a long academic track record, but can lag in bull markets driven by innovation. Neither style dominates every cycle, and that's actually the key insight. The smartest long-term investors don't go all in on one camp. They understand both, blend intelligently, and stay disciplined through market ups and downs. Whether you're investing through a 401k, a Roth IRA, or a regular brokerage account, understanding growth versus value makes you a more informed, confident investor. Build wealth with knowledge, not guesswork. That's what US Wealth Logic is all about. Before you go, everything in this video is for educational purposes only and does not constitute financial advice. The examples and historical data shown are illustrative and not a guarantee of future performance. All investments carry risk.